Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Trading Covered Calls and Short Puts. And in this webcast series, you'll see us selling calls and puts usually over the course of a few weeks, but there are some traders who will actually sell contracts that go on for years. Why in the world would a trader ever sell a long-term put contract known as a LEAPS option? I think there might be some logic behind that. We're going to be talking about the pros and the cons of selling long-term options for potential income. I think that it'll be an interesting discussion. Before we get to that, though, let me first of all say hello to everybody who's out there chatting in on YouTube. Great to see all the familiar names again. Hello there, Jay Richardson, Life in the Fast Lane, Eva, Mark, Kevin, John, Greg, Josh, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. It really is a great way to watch these webcasts, but also be aware that you're invited to join us in the live streams if you'd like to be here in the live stream audience. This is a Monday webcast series, and we kick things off promptly 2 Eastern time. We'd love to have you here in our audience. I also want to let our live stream audience members know that my very good friend Barb Armstrong has been hanging out in the chat. She's going to be providing assistance with any questions that I can't get to just during the flow of the presentation. Thanks for having my back there, Barb. And Barb and I would like to issue an invitation to everybody watching. If you have an account on X, give us a follow there. You should be following your favorite Schwab presenters on social media. You can find Barb on X at Barb Armstrong CS. You can find me there at Cameron May CS. We're both very active on that platform. And if you reply to one of our posts there, we try to reply right back to you. I also want to let you know that you can now connect with me on LinkedIn. So give me a follow there or a connect there. Love to have you there as a follower. Also, if you reply to one of my posts there, I'll try to reply right back to you. But let's get into this discussion of selling long-term short puts for potential income. Of course, there's going to be risks associated with this strategy, as there is with just about any approach to trading or investing. So bear this important information in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only. It should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. While this webcast discusses technical analysis, other approaches, including fundamental analysis, may assert very different views. Investing involves risks, including the loss of principal. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And any investment decision you make in your self-directed account is solely your responsibility. All right. So let's set the agenda for today's discussion. First thing that we're going to do is what we do each week. We're going to look at our current example trades in our paper money portfolio. Since this webcast is part of an ongoing series, there are some trades that we have that are already in play, just example trades, but they need our attention. I think that there are 3 that we're going to be doing something with today. Then we're going to have a quick peek at the markets to see what it's like for stock traders and for options traders out there, and use that as the backdrop to set the discussion for this presentation, where we're going to be, actually planning and placing a very long-term income option. We're going to be selling a long-term put option and weighing the pros and the cons of doing that. And I want to discuss how this is a very different approach to selling put options for income. It's kind of going to be a very different set of motivations than maybe you've seen before. So let's get right into this. Someone, Lou says, will this video get uploaded to the channel so that I can rewatch this? It is one of those webcasts that is scheduled to be added to the YouTube archives. So if you ever miss one of our archives, miss one of our webcasts, you can come to our YouTube channel. It's called Trader Talks Schwab Coaching Webcast. If you haven't subscribed to it, make sure you do that right now. It doesn't cost anything to subscribe to the channel. It only takes a second. Just click on the subscribe button. But we'll house the vast majority of our webcasts right here under the playlists link. So for example, I can click on playlists, scroll down about halfway over to the right a little bit, and you're going to see right here, trading covered calls and short puts. There's the full playlist for this webcast series. So yeah, this one is scheduled to be added to the top of this list after we're done. It's always a possibility I run into some technical hiccup that prevents this from being archived, but yeah, that's where you'd find it. All right, so one other thing that I'll point out, while you're on the channel, you can also join our live streams here. You can do searches for, key items, maybe items of specific interest to you. It'll scan through our archives. zero in on those things. Let's go look at our example portfolio. So we have 5 trades right now, most of them doing well. Broadcom, at least as currently constructed, not doing so good. Actually, that one's close. It's about a break-even trade, maybe a little bit underwater. But let's have a look at Amazon first. We just have 100 shares of stock, and this is not called trading stocks. This webcast series is called Covered Calls and Short Puts. So this actually was a covered call. The call has been closed. Let's look at the history of our Amazon trade. So we bought 100 shares at $221.52 right here on this oval. These drawings, that's what they are. I've drawn these all in just to illustrate the history of these trades. Well, we bought 100 shares at $221.52. Stock is solidly above that, so the shares are doing well. We sold a 24th of October call. That's been closed for $1.40 profit. We, before that, sold a 17th of October call, or 235 call. That was closed for $1.40 profit. So $2.80 in realized gains in our paper money account there, setting commissions aside, net $2.80 on the premiums collected, plus appreciation that we've seen in share value. We didn't have a covered call over this earnings announcement. We're just going to let that go, see how it went. And actually, it was quite positive. Amazon has pulled back since then. It might be finding a new maybe support just above 240. Let's change our outlook for this stock, or update it. Previously, we were watching to see if this support level broke. And maybe our trader might think support has now risen. There's an old resistance, maybe new support right up here. Let's say about 238. Looks like there's an intersection with this high and that low. Let's extend that to the right, and let's move this. Move this up here. Exit if support breaks, not on earnings. Earnings are now history. Let's just say, let's exit now if support breaks. So we're now starting to manage the upside of our stock. If we bought it down here, and our new price floor is here, if it breaks down below, we'll very likely be exiting with a profit on the stock. But in the meantime, let's sell a call against this. So that sometimes a trader might look to see where have recent highs been reached, where are apparent price ceilings now, and it looks like there might be one up here around that 260-ish level. How about we sell a call up there at 260, out there to the December expiration? All right, let's sell that call. Let's go to the trade tab. And what the motivation of the trader here might be, let's sell a call that we don't think will go in the money, that we don't think will be assigned. And hopefully, if our stock goes up in value, that's great. And if our call expires worthless, also great. Louise says, can you show how you did the writing? So for each of these, Louise, I'm just using the drawing tools that are accessible right down here in the lower right-hand corner. So you can make text notes using this tool. You can draw lines using this tool, ovals using that one. You can just get on and practice with those drawings, okay? In any case, let's do that. December 19th, 260 call. We just have 100 shares, so we're going to sell one contract for December 19th. Looks like that's trading around $6. Okay, it's about 2% of the current value of the stock, a little bit more. And let's sell that 260. So I'm going to click on the bid price to create an order. We're just going to modify that to just one contract. Let's sell that 260 call, 595. You know what? How about we back off on this requirement a little bit? I'm going to put in a limit at 590, saying in this case, we're willing to accept as low as $5.90 for the credit on this call. Let's click confirm and send. We're attempting to sell the 19th of December 260 call for $5.90. That's $590 if we can get it, minus 65-cent commission. Minimum acceptable credit here will be $589.35. Trade-off here, but the trade-off here is someone is going to have the right to buy our shares from us through the 19th of December for $260. So we're kind of putting a cap on how much we might be able to make on the stock for the next month and a half or so. So I'm going to send this order off. E. Dunny says, if you didn't want to actually get called away, would selling a shorter term call be any more or less likely if I want to sell a call, want to keep the stock? So It's a good question. It actually plays right into today's discussion. Shorter term contracts, well, if they're out of the money contracts, they're less likely to get assigned, but they can still get assigned. If the contract is out of the money and there's not much time for it to go in the money, theoretically it reduces the risk of assignment. So that's a check in the box for lowering the risks of assignment. However, we also discover, as sort of a teaser for what we're going to be talking about, when it's very short term, we can't sell very far out of the money or the premiums just dry up very quickly. So there are pros and cons to that that I want to talk about as we get deeper into this longer term put discussion. Okay, a very good question. Mrs. Ardzen says, is there a method to select days till expiration? There is no universal truth for all traders. We should definitely sell a certain number of days or definitely avoid a certain number of days. It's always a trade-off, because shorter term contracts, fewer days for surprises, also smaller premiums. Longer term contracts, more exposure to surprises, larger premiums. So is there a right answer there? Or could a trader just look along the range, along that spectrum of days available till expiration and find, okay, this looks like the right balance of exposure to surprises, but also premium for me? That's sort of the way that the trader might view it. In any case, let's look at the rest of our positions. We have Broadcom, just 100 shares. Here's what we've done with Broadcom. Just recently bought 100 shares at $361.10. The shares are down a few bucks, so underwater on the shares, boo. But we sold a 31st of October call that expired for a 283 profit. Yay. So actually we're about break even on this trade, a little bit underwater, kind of in recovery mode. There is an earnings announcement on the horizon that we might want to keep our eye on. So how about for this one, let's sell a call that will expire before that earnings. Not every trader avoids earnings, but we're going to here. And how about if we put that above recent highs, looks like maybe 390 might be above those highs. Trying to minimize the likelihood of assignment. If we do get assigned, we'd be selling our shares for 390 bucks. So we purchased for 361. So that would be sort of a forced profit scenario. In any case, let's go to the trade tab. Let's go to a contract that expires before earnings. So that would be, I think that was on the 10th. Let's go to the 5th of December. And let's go to that 390. What are those trading for? Okay, 565 to 610. Let's sell one of those. And make sure that we just have the correct number of contracts. It's like our natural is 585, 595. I'll leave it at 585. That's okay. I'll leave it right there. Maybe, well, let's nudge it down just a little bit. Try to improve the likelihood of a quick fill here. I like to do that when the camera's on so that we can get these things done while we're talking. But we're looking to sell that 5th of December, 390 call, trying to get 580 bucks minus the 65 cents, bring a minimum acceptable credit of 579.35 for this example trade. Please note, we have selected a weekly option series with a non-standard expiration date. This is not the third Friday expiration. It's a weekly expiration. Now, there can be pros and cons to those. They can deliver some additional flexibility in expiration selection, but weekly contracts also tend to be a little bit lower liquidity, just so you know. I'm going to send that order off. Zach says, hey, a short call, won't implied volatility work against you? It depends on what it does. And I think what you're saying is, won't it work against us as we're approaching expiration? Yeah, it's quite likely, Zach, that, or not expiration, but earnings. Our expiration is right before that earnings. And with contracts, quite commonly, the value of those contracts will go up as earnings approaches. However, for the contracts that expire before earnings, that tends to be less pronounced. Yeah, but we might be a little bit swimming upstream there. That's definitely a good observation. For a little while, we'll see. Ultimately, this thing's just going to expire. If it's It's going to come down to, is it above our strike or below our strike at expiration? Earnings not going to play a role in that. Volatility can, up to a point. Let's see. Ignacio says, hi, in some expiration dates, there's this word weeklies. What's the meaning of that? So yeah, that's a good question there. So I just discussed that a little bit. But yeah, when you see in purple here, weeklies, that's just a reminder that these contracts don't expire on the third Friday of the month. For a long time, all options contracts for equities expired on the third Friday, with very, very rare exceptions. Third Friday of the month. Now it's become much more routine that we have contracts that expire some other Friday of the month. And this just a reminder of that. Beyond that, some traders might not even care. That's what it means. Ignacio says, you just mentioned this was lower volatility, but do they expire every week? What's the actual expiration date? The one that the actual expiration date is the one that's displayed on the chain right next to it. So the one that we chose for this trade, for example, expires on December 5th. This one would be November 28th and November 21st and so on. Okay. So when it says weekly, it doesn't mean that it expires this week. It just means that it's a contract that runs only for a number of weeks, and it expires on a Friday that's not the third Friday of the month. Okay, so done with the Broadcom position. BAC, we have a couple of covered calls on 200 shares. We bought those shares for $50.58, sold the 53 calls. Here, if the trader prefers to not be assigned, they'd probably prefer for the stock to be below $53, even though out-of-the-money contracts can also be assigned. This stock has crept above 53 bucks. There's still 11 days till expiration. There is no assignment risk, no early assignment risk in paper money. That's where paper money and real life diverge. No contracts get assigned early in paper money. So I kind of have the luxury of saying, let's just leave it in there and see what happens. But a real trade here, if a trader decided to just wait to see what happens over the next week, it might get assigned. Assignment risk goes up as we go in the money. Now, would that be a tragedy for this trader? Bought the shares at $50.58, required to sell the shares for $53. That would be a realized gain on the stock, to which we would add the $1.27 collected for the option, along with any other contracts where we've previously exited. So yeah, in this case, we bought 200 shares. We've already made $1.07 per share profit on earlier contracts. Now we're in these contracts. They're now a little bit in the money. We'll see how they go. I'm going to let these work. Our break even is way down here, though. So that trade overall is just doing just fine. Next up is our NVIDIA position. Bought 100 shares for $183.71. Sold the 195 calls for $340. That stock has also gone in the money. 4 days till expiration. Boy, the trader here might really have something to think about. Here's what's going on with NVIDIA. 100 shares at $183.70. Sold the 195 calls for $340. We are staring straight in the face of assignment. Stock stays above 190 and 195 and get to expiration. Contracts will be assigned with almost no exceptions. In real life, almost no exceptions. In real life, there could be early assignment. I'm going to let this one go because as I do the math here, if we bought the shares for $183.71, if we sell those for $195, that would be a realized gain of over $11. In addition to the $340 that we already collected, that would be a nice profitable outcome. Now, if it reverses and goes down, there's still risk to the downside because we still own the shares. But I'm going to let that one go. And that leaves us with our Visa trade. We own 100 shares. We were assigned those shares at 330 bucks. They're trading right now for 335, so the shares are doing okay. Here's the history of our Visa trade. So we sold some puts, they expired, and we kept those for a profit. We sold some puts, those were assigned, so we had a profit on the premiums, but we were assigned the shares for 330. As the stock sort of settled into a sideways pattern, we've sold some calls and made some additional profits on premiums. So far we've made about $6 there, about another $3 here. So around $9 in realized gains on our premiums. Plus we're up about $5 on the shares. But we have a note right here. If the shares start to misbehave, we're going to dump them. But they're not yet. They're still holding above that support. Let's sell another call up here, maybe up at that resistance around 350 or 355. Let's go back here to our trade tab, go out to the 19th of December, out to that third Friday expiration. It's not that those are they're not inherently virtuous over other expirations. They do tend to have greater liquidity. Those third Friday expirations, the one that don't say weeklies, usually just have better liquidity. We could sell a 355 call, or we could sell maybe the 350 call. What do we think? I think I'm going to go up here to 355. So we're going to sell up here. Let's draw in a line around 355 above today's price, just so you can see where we're starting this trade. And let's carry it out to there. So we're kind of putting a ceiling on our shares right up at 355. But there's really quite a bit of wiggle room. Someone has the right to buy our shares at 355. Okay. Well, we bought those for 330. So that would be a $25 profit if we did get assigned, get called out. But we're also looking to collect about another close to $3. So let's go to that 355. I'm going to click on the bid price. Let's sell just the one contract for the 100 shares that we own. And 259 to 267. How about we say we're willing to settle for even 255? Click confirm and send. Selling the 355 calls, trying to get 255 out of those, meaning our minimum acceptable credit is going to be 254.35 after commissions. Let's send that order off. Oh, so we're into that, collected 267. Do we have any of those trades still working? No. Okay. Nope, those are not related. Okay, so we are in those new contracts. And so that means time to add a new trade to this example portfolio, but we're not going to do it blindly. Let's go have a look at what's going on with the stock market as we're speaking. I don't think this is going to be a surprise to anybody. We've had a nice run up over the last 7 or 8 months, had a recent pullback over the last 2 weeks, got what appears to be kind of a hammer candle here, kind of a bullish appearing candle, and continuing into today. So we're really only how far down below all-time highs. Let me do a quick measurement here. About 1%, 1.5% below all-time highs. Let's say that our income trader here is still bullish, still willing to add new covered calls or new short puts. Both of those are bullish strategies. This webcast series covers bullish income strategies. Let's say that since we're just bouncing, maybe our trader is looking to sell some puts below current levels, hopefully minimizing the likelihood of assignment with the objective of earning an income. Let's see. So, yeah, okay. Just reading some of the comments there. Looks like that was not a question. Reggie says, where would you put a stop on AVGO? I don't mind going back for just a moment, Reggie, just having a look here. Where might a trader who owns shares of AVGO and they're trading and they're selling calls against that decide to pull the plug? Well, I think some might notice we had a gap up back here a few months ago. Top side of that gap has been a pretty good support. Maybe for some traders, they may say, you know what, the trend still looks okay as long as we're above that level as an example. So possibly allowing this to fall as far as 320. Others might say, no, that trader's crazy. We've also had this nice upward slope to things. Maybe put their stop tighter. Tighter stops have higher probability of getting hit. So more of a whipsaw risk, but also less downside risk conceptually. That's just a couple of examples. I think I'm not going to actually put a stop in today, but hopefully that was helpful just as a demonstration. But there's the S&P 500, setting that backdrop for the kind of conditions that our trader is dealing with right now. Very bullish market conditions, unless one sees this as early signs of reversal. I think that's possibly a story still to be told. So that's what's going on with stocks. What about options? This is going to be an interesting addition to today's discussion. Options volatility has been comparatively low through most of the last 7 months. I don't think that's a surprise because the markets have just been going all up and up and up and up. There was definitely a prominent exception to that. But look at where we are right now. Got a spike in volatility. Today's Monday. Last Friday, a spike in volatility, and we've been coming down since then. Let's say that our trader thinks that volatility is more likely to kind of bleed out a little bit, going down lower. That could actually play a role in the strategies they select. And for an income investor, actually, if that's what happens, that's kind of optimal, because if we can sell while prices are high and then see prices fall, when volatility falls, it tends to drag options prices down. That might be good for our trader. Now, I just want you to keep that in mind. Let's just say that our trader has the outlook that volatility is high and likely to fall from here. All right. With that sort of burned in the brain, let's hit the pause button for just a second, because I want to point something out. There is a survey that's been added to the chat window here for our live stream attendees. So if you do me this favor, if you're here in the live stream audience, click the survey link and then just tuck that survey away to the side so that you can fill it out when the webcast is over. Just know that if you fill out that survey, it's a really short survey, 2 multiple choice questions. It also has a comments box and a suggestion box. But if you take the time to fill out that survey, I just promise you I'll take the time to read through those the survey comments. I read through the data, and it's always helpful. Never a wasted effort, okay? Thank you for doing that for me. Barb, thanks for reposting that. But let's get back to our discussion. And I want to shift gears here. So here is the scenario. Our trader, theoretical trader here, is bullish on the markets. They also think that volatility is likely to fall. Now, those two things may point directly toward, if they're an income-oriented trader, selling calls or selling puts. If we're bullish, doing covered calls is actually a bullish strategy. Selling puts is also a bullish strategy. And if volatility drops, that actually tends to help sellers of options, both of which apply to selling covered calls, selling puts. We're going to be selling a put today, but we're going to be taking a little bit of what some might consider to be a non-traditional approach to this. So I'm going to use Microsoft, and there's a very specific reason why I chose Microsoft, a couple of potential reasons. But we're going to be selling a long-term option. You more veteran options traders, what do you know about the nature of long-term options on illiquid stocks? Stocks that are not heavily traded. Those long-term options tend to have very wide spreads between the bid price and the ask price. They tend to be highly illiquid, difficult to get into, difficult to get out of, hard to trade profitably. So for that reason, some traders might choose to just go with the most liquid stocks out there when selling long-term options. Microsoft, guess what? Yep, one of the biggest companies in the world. Yep, Mark says big bid-ask spreads, right? Yeah, Kevin says same thing. So for that reason, I've stuck with some of the biggest companies in the world, including Microsoft. Now, another thing that a trader might notice here, when we're looking to enter into a bullish strategy, a bullish income strategy like selling put, maybe they prefer for the stock itself to be looking like it's bullish. Now, obviously, this has not been bullish over the last 2 weeks. A lot of stocks haven't been bullish over the last 2 weeks. But maybe our trader is intrigued by the fact that this sell-off has taken us right down to these 5-month lows and starting to rise again along with the rest of the markets. So maybe the conviction here is it looks like our stock is going to go higher, but it might not. Might not. Certainly it could come lower, couldn't it? Yeah. But our trader just thinks, okay, this is our setup. Let's try to get an income out of this scenario. So we're going to sell a put. Well, for some, They might think, okay, selling options, we always sell really short term because then we're not very far from expiration. There's not very much time for something unexpected to happen. And so they might go to their trade tab and maybe look at selling something that's right close to expiration. There are contracts that are only 4 days from expiration, 11 days. Maybe if they're going out to the monthly contracts to try to keep things as liquid as possible, maybe just like on those calls that we just sold, they go to the 19th of December. Well, let's look at maybe selling a put 19th of December. We could sell, let's go out of the money a bit. If we go maybe all the way down to, let's say that our trader likes to get at least, 1%. The 475 put, they could sell for pretty close to that, $4 and change. That's about 1% of the obligation that they're taking upon themselves here. And on our chart, that would mean that someone has the right to sell shares to them for $475. That's about right here. So if they took that trade, be selling right around there. If the stock were to fall, they might have to buy the shares for more than it's worth at $475. If it were to fall down below $475, that's a risk. But now let's shift gears entirely. And instead of going short term, trying to keep close to expiration, we're going to do what some traders think is just illogical. I'm going to say there can certainly be pros and cons to this approach. So there's certainly some logic to it. It doesn't mean that there's not risk as well. But we're going to go further out in time. And we are going to, just to exaggerate things to the greatest extent possible, we're going to go as far out as we can. I'm going to go out here to the 21st of January of 2028. These are contracts that don't expire for 802 days. That's like 2.5 years. There aren't any more that go out further than that. You'll notice that that's the bottom of the option chain. Yeah, so Eva says December 25th is not what I'd call long-term. That's coming up next month. Look at January of 2028. Yep, you and I are now on the same page, right, Eva? Let's go out here. And the first thing I want to examine is that one big potential advantage of this strategy. Now, don't get too excited. We need to talk about the risks as well. We're going to look at both sides of this teeter-totter. Anyway, if we were to look at the same strike, now we did 475. There aren't any 475 strikes available here. We could even do the 470 though. So for the 475, for that contract that expires in a month and a half, the trader was looking at maybe collecting about $4.50. Well, at a lower strike, they might get not $4 and change, but $50 and change. Going further out in time and adding lots of time to the contract delivers a much higher premium. Now, Mark says, I promise I won't get too excited. Okay, good. Yeah, this just illustrates that there are larger premiums. But if our trader is sticking to their same rule, let's say all they need is 1% or 2%. They could go to a much lower strike. What if we sold? And if we sold the 310 contract, that would still be 3.5% on the obligation. We're taking on, someone has the right to sell us shares for $310, for which the trader is collecting about $11. Yeah. Going way out in time delivers much larger premiums, for better or for worse. That's just an observation of fact. I think what we'll do, let's go back to our chart here. 310 would be off the bottom of our chart. Wow. Let's not do that. I don't want to have to squish the chart up and go back. It's going to be awkward. Let's stay on the chart. But let's look at, there was this huge gap back here on an earnings about 7.5 months ago, 8 months ago. The bottom side of that gap is down there at like 395. Let me draw on a line there. And what if our trader were looking at selling a contract below that? How about if we go to that 380 level? So to reframe this, instead of getting into a contract where someone has the right to sell us shares for $475, instead they have the right to sell us shares for $380. That is $125 below the current price of the stock, but it does extend way out there. Laura says, doesn't this lock up 50K? It could. If we're doing this in an IRA, Laura, yes, it certainly could. Not 50K, because we're not taking on ourselves an obligation to buy shares at $500 a share. We're taking upon ourselves the obligation to potentially have to buy shares at $380. So it would be $38,000 to have a cash secured trade in an IRA. But if I put this in a margin account, which is where this one is happening, this is another one of the big advantages. Great. So number one, bigger premiums. Number two, I think you're seeing as an advantage is we're able to sell strike prices that are way, way, way out of the money while still getting comparatively large premiums. Look at this. This would still be a $23 contract. $2,300 someone is paying for the right to be able to sell us shares for $380 sometime in the next 802 days. I'm gonna stick with that one. Okay, let's just call it $23. Let's say we're able to get $23. Not all the way down to the bid price, but pretty close, right? So larger premiums, much further out of the money, but also let's compare that to, Laura points out how much money gets tied up in this trade. If I were to click on this, actually, let's do this. Let's compare that. Let's go back to our original proposal, the 19th of December. If I were to sell, like, let's say the 475 strike, I click on that. Let's do one contract, and I'm going to click confirm and send. This page will tell us how much money is being tied up. The buying power effect of the trade is about $7,100 in a margin account would be tied up to cover the potential risk of the trade. Now, might not cover all the potential risk, but this is how much cash would be required. Remember that, $7,100 in pursuit of about $455. Right? Now, if we compare that, let's go back out to our really long-term option. And we're going way further out of the money, a much lower probability of assignment. And if we do that one contract, confirm and send, we're pursuing $2,300 and tying up $3,800 in doing so. Okay, that is a much lower margin requirement because we've gone further out of the money. We've reduced the risk of assignment and lowered the amount required basically to cover potential risk in this trade. So are we stacking up the pros? Is this thing constructed entirely of advantages over the other trade? No, there are definitely disadvantages here. And you're probably already saying, yeah, but Cameron, but you're forgetting something. Now, I talk about the pros first, get the fun stuff out of the way so we can put the emphasis on the risk and on the cons so that the trader can make a really informed, balanced decision here before ever deciding, even in paper money, whether they're going to do a trade or not. So Kelly says, okay, let's see. Cam, can you explain what you mean by 1% when you choose a strike and look at the premium? Yeah, so what we're doing is looking at the strike price. So 380, what we're doing is someone has the right to sell shares to us for 380. In other words, we might have to buy the stock for $380. If we were to get, let's say, a $3.80 premium, that would be 1% of the size of that commitment. Does that make sense? So for some traders, they make that like a minimum. Now, not every trader does it that way. I'm only using that as an example. That's it. Okay. But Kelly says, what are some of the cons? Okay, let me make sure that we've covered the pros. Larger premiums, even way out of the money. When we go way out of the money, there's also lower assignment risk. Somebody could decide that they're going to sell their $505 stock to us for $380. It's just unlikely. Now, the margin requirement is lower. Premiums are bigger. And if we do get assigned, we're not buying the stock for $500. We're buying the stock at $380. So much lower price compared to day one. Now, $380 at the moment of assignment may be overpaying substantially at that point, but it would be less than the current price of the stock. Okay, so those are some of the pros. Those are some of the potential advantages. What are some of the risks? 802 days. Let me say that again, 802 days. These are long-term contracts. The time decay tends to be very gradual, still positive, but not a lot of time decay. So the funds may be theoretically tied up for a long time. However, I would say that for some traders, even though they're getting into a contract that's 802 days till expiration, they may have no intention of staying in that contract for 802 days. What they may actually be expecting as they look at their Greeks for this trade, what's really driving this trade? Let's look at this. Theta, minor player. 3 cents is what it's contributing over the course of 24 hours. Delta is a bigger player. As the stock, if the stock continues to rise, that will reduce the cost to buy out of this contract. Delta is a much bigger player. So if a trader is really bullish, they may actually see faster returns than having to sit around on this for 802 days. They might be able to get out much sooner if the stock is cooperative and it keeps going up. However, look over here. Vega, this is this trade's exposure to volatility. Vega assumes that volatility is going up. If it did, this contract would go up in value, which is not what we want. But do you remember when we looked at the VIX? Volatility generally may be heading down. In the relatively near term, let's go back to our Microsoft here. If volatility drops, go back, where were we? 380, there we are. That can actually chip away in chunks at the value of this contract. Now, with an earnings announcement, had we sold it, well, with an earnings announcement, that could spike it up a little bit for a period of time. We have to be aware, for a trader who's doing something long-term, they might have to wait through earnings. Yeah. So, but keeping an eye on Delta, this is more of a bullish trade than it is a time decay trade. And we keep an eye on Vega. All right, so let's see. Any other questions here? There we go. But I just wanted to cover some of the pros and some of the cons as we dive in. We're going to sell this contract way, way, way out of the money. And then we're going to see if we can let it get closer to expiration, but probably exiting well before expiration if the stock continues to cooperate. We're going to sell that one contract for, let's try to get 2280 for it. I'm going to click confirm and send. It's going to tie up $3,800-ish. Let's see if we can get 2280. That would be a minimum acceptable credit of $2279.35 after commissions. We're going to obligate ourselves to maybe have to buy shares at $380 sometime in the next 2.5 years, unless we choose to exit earlier, which is probably what we're going to do. We're going to look to see if price and volatility combine to allow the trade to be closed out well before then. Okay, there we go. So I sold that in our example margin account. Guys, we've accomplished what I wanted to do today. I wanted to go through our current positions. There were several things that needed to be done there, or that I thought needed to be done. So we've added to those positions. We took a look at the markets. We've placed a new trade, which is a longer term put, really hoping here, if the stock goes up, that put should lose value, and we'll try to close it out. Maybe the trader closes it out. Maybe if they can just get out for 50% of their original entry price. But guys, we'll keep an eye on that in coming weeks, talk more about the management of the back end of that trade. There is a survey out there. Thank you for filling that out. Here's your opportunity to click on that survey again. But I want to let you go enjoy our other educational offerings. Still a couple of webcasts coming up. Go enjoy those, but make sure that you're following Barb and me on social media as well. Follow Barb and me on X. You can find Barb there at Barb Armstrong CS. You can find me on X at Cameron May CS. And if you reply to one of my posts here, I do try to reply right back to you. So there's my handle. But you can also now follow me on LinkedIn. There's my profile, so you'll know you have the right guy there. Just 100 people following me so far, so be one of the early crowd there. Everybody, thanks for all the thumbs up. I can already see how many people watching. 200 people watching. 62 thumbs up already. That's awesome. Thank you for doing that. That very much appreciated. It also gives a boost to my video in the YouTube algorithm. Helps more people find these webcasts. So thanks for doing that. Lana says, why 380? So I kind of did it based on the chart, a previous prominent area of apparent support, but also just to make sure that we weren't off the bottom of the chart. So it'd be an easier visual for me, but we could have sold further out of the money for a lower premium and a lower probability of assignment. Pros and cons, right? But everybody, I will see you in next week's webcast. I have other webcasts between now and then. I'll look for you on X. I'll look for you on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.